You're going to see not just the next 5 weeks or 6 weeks going into the election being stressful, but the next 3 months after that, at least, being very stressful. But we see a lot of economic and political pressures continuing into 2026. So we think that the gold and silver prices will stay high, and gold prices may move even higher later in 2025 into 2026.
So is $3,000 possible by next year? Jeff Christian joins us once again. He is a managing partner of the CPM Group. Jeff was on the show several times this year, having called for the gold price to reach an average price of around $2,600. Well, we're past that now. So what's next? We'll talk about gold, the precious metals, and news coming out of China regarding their new stimulus package and how that may affect other commodities as well. Welcome back to the show, Jeff.
Thanks for having us back, David.
Well, congratulations on your gold call, first and foremost. We're going to come back to gold in this later part of the interview. Let's talk about what's going on in China first. Let's flip over to my screen. This came out earlier this week. The People's Bank of China cut a key short-term interest rate and announced plans to reduce the amount of money banks must hold in reserve to the lowest level since at least 2018. Appearing at a briefing alongside two of the country's other top financial regulators in Beijing. This marked the first time reductions to both measures were revealed on the same day since at least 2015. So as you know, Jeff, the Chinese economy has been slowing down. It's been speculated what they would do, the People's Bank of China would do to bring the country out of a deflationary spiral. Before we talk more about this, what's your initial reaction to this Chinese stimulus package? And we'll talk about mining companies and also the metals themselves.
Okay. I'm not surprised at the announcement of the stimulus package, and I'm not surprised at the size of it. We have always had this view, which is a little bit different from other people in North America, perhaps, that China has tremendous financial resources, and it is a communist country, and it does have a managed economy. So it has economic and financial levers that are not available to other countries, other governments. And we've always said that the Chinese government has the capacity to contain the real estate crisis and other financial crises as they come. And part of the Chinese Communist Party's view is that it cannot, and China cannot, afford creative destruction, like Alan Greenspan always talked about with American capitalism. Throw a lot of money at different things and there'll be failures, but there'll be successes. And China has never, and the Communist Party has never accepted that as a desirable way toward economic development. It's always been, let's make sure that we have, let's increase the assuredness of success as much as possible. So China has these tremendous resources, and it's interesting because they had perhaps lagged a little bit in deploying them, but the announcement, over the last couple of weeks, just signifies to us that the Chinese government and the Chinese Communist Party has saying, okay, what do we have to do to get the economy out of this slump? And it's not necessarily a deflationary slump. It's more, I think, a disinflationary slump. And it's also part of a maturing economy. And it's also part of an economy that, unfortunately for Chinese managers, reflects the fact that there is increased intergovernmental tensions and hostilities between the Chinese government and many other governments, not just the United States and Canada, but also, South Korea, Japan, Taiwan, the Philippines, Southeast Asian countries, Pakistan, India. They have issues, and but they also have the wherewithal to deal with it.
Well, let's put it this way. Suppose the Central Bank of China did not intervene in any way. What would have been the trajectory of the economy?
I think the economy would have bounced along. It's an economy that it could have dipped into a recession, which would have been highly unusual for the country. But it also, that would reflect some of the political changes that have occurred in China over the last decade or 15 years. So I think that it's very important for the government and the People's Bank of China to provide these stimuli, fiscal as well as monetary, to get the economy going again, and again to refocus on its need for domestic demand, given the changes that we're seeing in its export-driven economy and the export markets for its products up until now.
I'd like to take a minute now to talk to you about a great way to buy physical gold through a trusted dealer. Our sponsor today, One Gold. Launched by trusted industry leaders in APMEX and Sprott, One Gold allows you to own vaulted gold, silver, and platinum in your choice of secure vaults around the world. With One Gold, your holdings are fully insured, audited, and IRA eligible. One Gold is an intuitive and secure alternative to precious metals ETFs and offers an array of unique investment tools like the bullion card, auto invest, limit orders, and more. Thousands of customers are using One Gold as a complement to their physical assets using their regular at spot promotions. Additionally, One Gold offers unparalleled liquidity with same or next day cash withdrawals, 24/7 trading, and physical redemption. Get started today with a few clicks from onegold.com, link down below, or scan the QR code here, or by downloading the One Gold mobile app in the Google Play or App Stores. So let's take a look at market response to this news. According to Reuters, copper and lithium miners rose on the news. Freeport-McMoran, for example, up almost 8%. Southern Copper added 7%, and a host of other companies as well. It was reported as well that copper prices and lithium prices bounced a little bit. If you take a look at the copper price here, the news was announced sometime here, and so yeah, we did get a bit of a bounce. Although the copper price has been on an upward trajectory, I'll point out, ever since the beginning of September. And so I don't know if this recent rally from the last 2 days was entirely due to the news, but anyway, I'll let you comment on what this story means for base metals and commodities overall.
Insofar as, if we assume that the Chinese government and Chinese monetary and fiscal policies are successful in plateauing and rejuvenating economic activity, you would expect increased demand for copper, lead, and zinc, and aluminum, and nickel, the basic base metals. And so you would expect to see increased demand. And China has been one of the major, refiners, smelters, refiners, and consumers of a lot of base metals, as well as precious metals and specialty metals, for decades. So it's a very important part of the global market that leads to prices. So you would expect strength. Copper prices have risen, as you said. Copper prices were rising sharply, not only since the beginning of September, but really since, I guess, the middle of August. And they're at very high levels. That reflects a variety of issues, one of which is, will China rejuvenate? Another one was the expectation of lower interest rates in the United States and the expectation of lower interest rates in the rest of the world, some of which were already, cutting interest rates. So the view was that economic activity might plateau and strengthen not only in China, but in other countries. You've had this two-part strain of bullishness about copper. Oh, yeah, we have short-term tightness in the market and the price is going to rise. You've had various interruptions, some geological, some labor union issues. You have increased resource nationalism. Then you have this longer-term thing about the energy transition is going to need all this copper. And you have these various promoters going around saying there's not enough copper being mined to meet all of the demand. Copper prices have to rise sharply. So there's been a nascent bullishness. It had gotten a little bit inert for a while, and now it's coming back. And there are all these different reasons to be bullish on copper. Has the copper price at $4.50 a pound in COMEX this morning? Is that a little overdone? Probably. Might we see the price come off over the next few months if economic activity shows signs of further weakening in North America and Europe? Yes, it's possible. Does it come off very sharply? No, it doesn't, because there is this there's a good base, not only in copper, but you're seeing it in other base metals and in precious metals too. So even if you do see a round of profit taking and long liquidation in any of these markets, the prices are not going to fall back really sharply because there are any number of investors who are looking at the state of the world economy, the world political environment, and saying, I think that, these metals prices are probably going to stay higher.
Do Chinese investors or the government or industrial companies need to even buy some of these metals? The assumption, I guess, from the market is that as the economy is rejuvenated by stimulus, they'll need to buy more metals. I would be surprised if China doesn't have stockpiles of gold, copper and lithium and other base metals at their disposal.
I'm not quite sure how big of the stockpiles they are. Yes, there are metal stockpiles. The Chinese government has a stockpiling agency. Individual companies do too. But I think that those are kind of seen as strategic stockpiles, and you don't really want to draw on them unless and until you see a significant global disruption in supply. And we have those stockpiles there against that against such future interruptions. And in terms of needing more metal on a day-to-day, month-to-month basis, we go into the market to buy it.
Okay, I like to segue into lithium now. This is the chart of the lithium prices. A huge surge between 2021 to 2022 and a subsequent price collapse thereafter back to basically pre-2022 levels. And now the question is whether or not the EV industry is, well, I guess it's a multi-part question, but the first question is whether or not the EV industry is going to grow at a previously anticipated pace enough to warrant a lot of additional lithium demand. And the second part of the question, I guess, would be whether or not there is a glut of lithium supply online right now that warrants such a low price relative to 2 years ago. I'll let you comment on this dynamic here.
Right. We have for years staked out points on both the supply and demand of lithium. In terms of the demand for lithium, we have been on record for years as saying that yes, electric vehicles are growing, and for the foreseeable future, lithium ion batteries are critical to the electric vehicles. You have research that's been going on for decades in alternate battery technologies, but some form of lithium ion battery seems to be the most likely power source for electric vehicles and electricity storage systems, which are equally important but often overlooked. So we thought that the demand for lithium would grow, but we've said that politicians and corporate chieftains and a lot of other people who were projecting a very rapid growth of electric vehicles were way too optimistic. We said you cannot get to 50% of the vehicle market being electric vehicles by 2030 or 100% by 2035. We have perhaps 35% of the vehicle market being electric vehicles by 2050. So it's going to be a much slower, longer term transition, in our view, in terms of the growth of the EV market. And what we're seeing is a lot of those people who were overly enthusiastic on the demand side have been pulling back. Now, on the supply side, we've made 2 points for, I don't know, 15 years or so. First thing is SQM has a tremendous ability to produce lithium at extremely low prices. And it has the ability to increase its production, as we've seen over the last couple of years, really at the turn of the crank of a valve. So the second thing was, we've said, as you see the electric vehicle and the ESS markets use more lithium ion batteries, and these things retire after 5 or 10 years, you're going to see such an enormous stockpile of spent lithium ion batteries that you would see recycling of the lithium. For years, the big nasty secret in lithium ion batteries has been these batteries are recyclable. They're not recycled, but they are recyclable. and recyclers would buy them. They'd burn off the lithium and they went after the cobalt. But we have said since at least 2010, 2015, we've been saying that you would get to a point where the lithium ion battery industry would have to start using recycled lithium as opposed to newly mined lithium. And if you put SQM's ability to produce lithium cheaply and quickly, and you put that together with the recycling of spent catalysts, we didn't see the need for a lot of hard rock lithium mining. And we advised our clients to avoid investing in lithium exploration, pre-development, and development mines outside of southern South America. There are some places in southern Argentina as well as southern Chile that are attractive. So we're not surprised to see the lithium price come off. And the lithium price came off, to be honest, because of a backing off from purchases of electric vehicles outside of China. We thought that the market was far too enthusiastic about lithium, and we continue to think it is. Has the sell-off overdone itself? I'm not quite sure that we are in an oversold position in terms of lithium. And part of that has to do with what's the short or intermediate term economic outlook? Are we headed into a recession in the United States, Europe, and Japan over the next 2 or 3 years? How deep of a recession it would be. If you see a recessionary economic conditions in industrialized countries, and you see further declines in autos and further declines in auto EV purchase and production and sales, then the price of lithium probably could fall even further over the interim, intermediate term, next 1 to 3 years.
I've read some research regarding whether or not there's enough lithium to support the transition to EVs, no matter what the timeline is. I think the consensus is that there are enough reserves, but perhaps production needs to pick up. Let's flip over to my screen now and talk about production. World mine production of lithium by country 2022: Australia, Chile, China, Argentina, and Canada in number 8 place. Okay, so I think the story here is that the U.S. needs lithium for its transition to EVs and the electrification of the industry. There should be enough reserves in the world for this transition to take place, according to some research that I've read. However, the concern is whether or not there's enough production in North America to meet this demand. As I've shown in this table, the U.S. is not on the top 8. So it's just a matter of national security that the United States needs to ramp up production of lithium and not rely on some of these other countries.
Well, yeah, I mean, there's a virulent trend of strain of resource nationalism that's spreading across the globe, and it's particularly strong in the United States. There are a lot of people who keep talking about how the United States needs to be self-sufficient in all of these different metals and commodities for strategic and critical reasons. And I'm not particularly in that political camp. I'm more of an economically oriented person. And, I think that it'd be much more efficient and effective for the U.S. government to focus on rejoining and improving its relationships with other countries so that we have a more cooperative relationships with these different countries. It'd probably be a lot cheaper and a lot less economically and environmentally destructive to do that than to try to subsidize development of sub-economic U.S. lithium projects in environmentally and culturally sensitive areas. It doesn't make sense to me. I would rather have good relations with lithium suppliers, and then when the lithium demand doesn't meet the bullish expectations and those lithium suppliers go bankrupt, it doesn't happen in the United States, it happens overseas. It doesn't make sense to me to pour good money into a highly speculative industry that hasn't justified its investments in the private sector on its own.
So which of the metals, non-precious metals, in your opinion, has the highest potential for return at this point in time?
Well, we're still very much interested in high purity manganese. We're also spending a lot of time actually with tantalum and niobium, which have numerous uses in semiconductors and other high-tech electronics. And nickel obviously is very important, partly for the battery industry, but also for stainless steel. So those are some of the metals that we're paying attention to. We do like copper, even though we think that perhaps it's a little, it's at the high end of its near-term range.
Mhm.
I should say that, we're actually in the process of our annual review of our long-term copper supply, demand, and price projections right now. So I'm not quite sure how that'll shake out because I haven't been looking out over Carlos's shoulders as he's doing that.
Okay, well, we'll check in with Carlos at some other time, Jeff. Let's move on to the precious metals then. So, again, I congratulate you on your call for gold. It's reached $2,600. What's next? That's my first and very simple question.
Yeah. Well, we're looking at the next 7 months. The next month is the run up to the US election. And then you have the post election situation. And then you have the first quarter of 2025. And our expectation is that you'll have a relatively less sanguine, more hostile economic environment in the United States, Europe, and Japan, China, and other countries. That we're going through the late stages of a mature economic expansion, and I think there are issues there. There are issues with supply constraints, especially on the service sector. Some of the supply constraints that we've seen in the goods sector have been alleviated. But if you look at Europe, you look at Japan and other countries, you still have a lot of inflationary pressure spread throughout the economies. In the United States, it's primarily medical and transportation services where you have this more intransigent inflationary pressures. So we think that you're going to see somewhat more hostile economic conditions over the next 7 months. You'll see the US and other central banks reducing their interest rates to try to protect from that. You already have seen a sharp reduction. I mean, fiscal stimulus and fiscal spending still are way out of control in the United States and other industrialized countries, as well as several emerging economies. But the fiscal largesse is half of what it was in 2020, 2021. So you've seen a constraint on the fiscal policies in terms of their effect in stimulating and keeping the economies growing. You're also seeing the supply and demand constraints in the real economy. And so our expectation is that you'll have greater economic uncertainties and nervousness over the next 7 months. And that's going to be on top of political uncertainties. We are going into a highly contested election. The Republican Party has made it clear they have already prepared their filings in all 50 states to contest the results of the presidential and congressional elections. So they're making it clear that they are not going to accept any losses. And that could mean that you're going to see not just the next 5 weeks or 6 weeks going into the election being stressful, but the next 3 months after that, at least, being very stressful. You have political problems in the European Union. Russia is having a lot of problems internally, and its war effort is, well, those 6 days have stretched into 3 years now. There's the Middle Eastern situation, Israel versus Hezbollah, as well as Hamas, as well as the Houthis, as well as Iran. You have a lot of unsettled politics, both international politics and domestic politics around the world. And we think that politics, the unsettled nature of the politics, is perhaps going to be even more important to gold and silver investors than the economic conditions. But we're looking at a bouillabaisse of hostile economic and political conditions. So, to answer your question, our expectation is that gold and silver prices will rise sharply at some point over the next 7 months. You'll probably see further new records in gold, and you may well see record silver prices in the next 7 months. In addition to which, we don't see things getting really great after April. maybe things get a little bit better after March of next year, but we see a lot of economic and political pressures continuing into 2026. So we think that the gold and silver prices will stay high and that silver prices might move even higher and gold prices may move even higher later in 2025 into 2026.
Okay, so just to clarify, are you updating your average price of
Yes.
$2,600? Okay.
Yes.
What is the new average?
I'm not quite sure whether it is. It's
Okay. It's going to be
actually,
someplace higher. Okay.
yeah, it will be higher.
Okay. Well, look, $3,000 on a percentage change basis is not too far from current
Mhm.
levels. I mean, as the nominal price of gold gets higher, each additional incremental 100 is just less in terms of percentage gains. So is $3,000, I guess, I don't want to say likely, but is it possible by next year? Does that make sense to you?
On an intraday or a daily basis, yes.
Okay.
Would the gold price average on a quarterly or annual basis $3,000? That seems improbable. It's possible, but the probability of gold prices getting that high,
Mhm.
that's in the scenario where we have a civil war in the United States. Yeah.
Yeah.
If you have a scenario, our main scenario doesn't have that civil war. Our main scenario has political tensions continuing and continuing to stimulate investors' desire to have more metal in gold. And in that kind of environment, you could see a spike to $3,000 easily, but I don't think that you can see gold sustained at $3,000 in 2025.
Okay. Just to touch on inflation, what is the interplay between gold prices and inflation? If you take a look at my screen here, this is from the BLS website. This is the 12-month percentage change in the CPI. So
Yeah.
in 2011, when the gold price peaked back then, the inflation rate also peaked. It trailed down lower and hovered around a stable
Mm-hmm.
0 to 1.5 2%. So it wasn't very high basically in
Right.
the last decade. Now we are having a similar dynamic when the inflation rate is trailing lower towards 2.5%. We don't know if it's going to go up. That's a conversation for a separate time. But let's assume it stabilizes around this current level. Are we going to see a repeat of what happened in the last decade when the gold price fell from, I think, 1900 something to back down to close to $1,000? People back then blamed it on lower inflation. Um, so is there a relationship now still between, we have lower
No,
inflation.
you
Does that
know,
portend
over,
lower gold prices?
over the long run, the statistical relationship in month to month changes in gold prices and inflation is 9% in the long run. But you can have periods of time where the relationship is much greater. And I think that what you saw there was that inflation and gold prices were both responding to very weak overall economic conditions and very weak balance sheets on the part of investors. So, investors around the world after the global financial crisis and the Great Recession did not have a lot of money to invest, and they were licking their wounds. They were trying to adjust to a zero interest rate policy and era, and what did that mean for investments? And with the low inflation, I think a lot of investors said, well, I don't need to think about gold right now. And that was our view. I mean, our view in 2011, 2012, when we issued our sell recommendation on January 3rd, 2012, we said gold could fall for the next 3 to 5 years. And it did. And that was predicated partly on the idea of a lower inflation. Insofar as we now expect inflation to, as you say, sort of stabilize in the 2 to 3.2% range over the next several years, that's mildly supportive of gold investment demand and prices, but it's not really forceful. It's not that 5% or 7% that really gets people worried. We look at a host of factors that cause investors to want to buy gold. And inflation may be the least important of the 6 sets of factors that we look at. We look at interest rates and currency markets and overall economic conditions and the relative performance of stocks and bonds and the political environment, both domestically for each individual investor category and globally. We look at all of those other factors and we say those things are probably more stimulative investment demand now and for the next couple of years than inflation.
Okay, let's take a look now and close off on silver. So you brought up silver. This is the price of the silver. Um,
Mhm.
Now, this chart shows that it's appreciated by an order of almost 22% since its lows in August. Let me overlay this now with gold, and you
Yeah,
can see that it's as expected, there has been a pretty close correlation year to date. However, let me replace gold now with copper. Take a look at this. I think you know where I'm going with this,
yeah,
Jeff. Um, Also, not a bad correlation. So, what
right.
is silver tracking right now? Is it a precious metal or is it a base metal?
It's both, and you have to understand that a significant portion of silver mine production comes from copper production.
Yeah.
So that when the copper price starts rising, you would expect increased copper production and silver production. But silver's a schizophrenic metal, and you know probably 90% of the silver being refined every year right now is going into industrial products and jewelry and silverware, manufactured and fabricated products. So, from that perspective, its relationship with base metals like copper is very important. However, it also has this financial aspect to it too, which it shares with gold. It is There are more investors in more parts of the world who turn to gold as opposed to silver. So gold has a more dynamic punch to it when investors look at that menu of things that I just talked about. When those things are all flashing red, investors are more inclined to buy gold than silver, at least initially. That said, silver has some very good dynamics to it. And if we see, right now, despite what promoters say, right now, last year, silver investment demand on a net basis was probably around 50 million ounces, pretty low. Is rising this year, and the price of silver is rising further. If we continue to see investors pivoting into silver, we can see a pretty healthy increase in silver prices. And in fact, if you look at our quarterly price projections for the next 2 quarters, the fourth quarter of this year and the first quarter of 2025, we have silver prices rising twice as fast in percentage terms as gold prices. So I think that silver's got a lot going for it. It's a tighter market. It's a smaller market. Less money going into silver has a more dynamic effect on the silver price than the same amount of money going into the gold market, because the gold market is roughly 9 times larger than the silver market in dollar terms.
Do you expect the gold silver ratio to widen given that there are a lot of macroeconomic and geopolitical factors, which you've outlined very clearly today, that may push the gold price up, but then the global economy may slow down, which may push silver and other base metals down?
Our expectation is that over the next 6 or 7 months, the gold silver ratio may actually decline. But
Mm,
then beyond April of next year, we wouldn't be surprised to see if gold starts to outperform silver again for a
interesting.
while. But
Okay.
I think they're going to hand the ball back and forth as they move down the field. So, the next 7 months, we're looking at silver maybe outperforming gold. Then from April until August of next year, depending on what the economic and political environment is, gold might outperform silver. But then by the time you get into late 2025, early 2026, silver may start outperforming gold again.
Very good. I appreciate your outlook and educating us and updating us as always. Where can we find out more about you and learn more from your work?
cpmgroup.com. You can buy our yearbooks. You can buy other reports. You can send us emails at info@cpmgroup.com and say, help me, help me manage my exposure to precious metals and commodities.
Okay, we'll put the links down below. Thanks as always, Jeff.
Thank you, as always.
And thank you for watching. Don't forget to like and subscribe and follow the CPM group in the links down below.